You've just found a confident setup on EUR/USD, and you execute a standard long position, carefully risking only 2% of your account. Moments later, you spot an identical technical setup on GBP/USD. Believing you are properly diversifying your portfolio across different European assets, you enter another 2% position. Then, a single unexpected news event hits the wire. Both positions collapse simultaneously, leaving you with a sudden 4% drawdown. Trading different currency pairs does not automatically mean you are distributing your risk. In this case, both trades are anchored directly to the US dollar. Treating individual asset charts as isolated bets creates a dangerous blind spot. It hides the overarching macroeconomic forces that secretly link these positions together. To diagnose this hidden risk, we look at statistical correlation, a measure of how two seemingly independent assets move in relation to one another over time. We track this using the correlation coefficient. This metric operates on a strict scale, ranging from -1.0 to +1.0. A reading of exactly +1 means two pairs move in perfectly synchronized steps. A -1 indicates they move in exact opposite directions. The critical thresholds for traders sit at the 0.7 marks. Any reading above +0.7 or below -0.7 confirms a statistically strong link. Looking back at our initial trading loss, Euro-USD and GBP-USD often share a high positive correlation well above 0.7 because both pairings are heavily weighted against the overall strength of the US dollar. Entering multiple trades with a high positive correlation is not diversification. You are unknowingly multiplying your exposure to a single centralized point of failure. You can use a pair with a strong negative correlation defensively, deploying it as a hedge to protect an existing position. If you hold a primary long position on EUR/USD, you can protect it from short-term dips by opening a smaller, simultaneous long position on USD/CHF. When the euro falls against the dollar typically rises against the franc, offsetting your temporary losses. Correlation also works offensively as a tool for trade confirmation. Checking a highly correlated partner pair can validate your technical signals and filter out false breakouts. This chart shows two correlated pairs. If EUR/USD pushes through a key resistance level, you wait to check GBP/USD. If that partner pair breaks its own resistance simultaneously, your signal is validated by broad market momentum. Applied correctly, correlation analysis acts as both a protective shield against sudden volatility and a proactive filter to isolate only your highest probability trading setups. The main trap for traders in 2026 is treating historical correlation data as a fixed law. These metrics are fluid. Central bank policy divergence, specifically shifting interest rates, can instantly rewrite long-standing relationships between currency pairs. If the Federal Reserve pivots its monetary policy while the European Central Bank holds rates steady, the historical correlation between their currencies will inevitably fracture. Localized economic data or geopolitical events can suddenly decouple previously linked commodity currencies, requiring constant vigilance to track. Correlation does not equal causation. Pairs move together due to unseen third factors, like shifts in global risk appetite, not because they directly control each other's price action. Surviving the modern market requires actively matching your correlation timeframe to your specific trading horizon. Relying on an outdated daily matrix to manage an hourly scalp turns a powerful tool into a dangerous liability. The modern relational trader conducts routine macro reviews. They step back to identify the overarching themes driving their open positions, rather than managing them in isolation. Beyond simple confirmation, a sudden breakdown of a long-standing correlation provides a powerful early warning system. This visual shows two historically synchronized pairs. If your primary currency pair surges to a new high, but its correlated partner completely fails to follow suit, the underlying relationship has broken. This stark divergence suggests the momentum is isolated and potentially unsustainable, giving you a statistical reason to exit before the broader market turns against you. Manually tracking constantly shifting multi-timeframe relationships across a global portfolio is mathematically impossible without the right infrastructure. FXNX provides the exact diagnostic instruments required to do this, featuring built-in dynamic correlation matrices and real-time data feeds. Deploy these powerful, institutional-grade tools directly into your daily routine to accurately map the relational risks currently influencing your own portfolio. Mastering dynamic currency relationships turns the invisible threats of the 2026 market into a distinct, measurable competitive edge. Open an NX1 account today and start trading with a clear view of the entire board.